with interest rate at about 5.25%. So this is based on the Fed's dot plot that we should be having interest rate at 5.1% by end of 2024 and 4.1% by end of 2025. So that is about 1 cut in 4Q and then 4 cut in 2025. As you can see here, these are projections by the Federal Reserve. They do the survey every 3 months, and you can see that Fed fund rate dropping to 5.1 and then subsequently to 4.1 by the end of 2025. There is anticipation of further drop in 2026, but I think 2026 is still too far away. That's about 3 years away. So what we have done is currently factoring in the potential cuts that we will see in 2024 and 2025. So the rate cut would commence quite soon, but the magnitude will be quite limited. This survey is done every 3 months, and you can see that over the last 6 months, this view that interest rate will be higher for longer has taken root, and then but the impact is quite mild. There is some increase, in the projection for interest rate, but it is very marginal change over the last 6 months. Yes, the market has swing up. The bank share price has swing up. Expectation for inflation and interest rate has changed, but people's expectation of where interest rate would be, actually the fluctuation has been quite limited. Okay, so we have had interest rate being cut by various countries. Okay, Swiss National Bank, Switzerland was the first to cut. That happened in March. Subsequently, Canada and Europe also cut. In both cases, they cut by about 25 basis points, and they done that in June. The thing is not happening in the US. US has been a laggard in cutting interest rate. We expect them to do so starting September. So why is it that we have this delay in the US? I think in Europe, inflation has retraced and moved down more faster than in the US. So in the US, fiscal policy is very, very assertive. Fiscal policy is very, very aggressive. There is various measures that try to promote investment in the US. So, for example, the Inflation Reduction Act provides a lot of tax credit for investment in renewable energy. Same thing in the case of semiconductor. There's a lot of subsidies being provided to attract more companies to bring manufacturing of semicon back to the US. So all these incentive and subsidies are causing, are attracting a lot of investment in the US back to the US, and therefore growth and inflation is higher in the US. The government is also spending a lot more, so there is a huge budget deficit. Their spending, it's not just during COVID, even after COVID is over, this huge deficit continued to be there. It is right now 7% of GDP. So we have a situation whereby all this government measure is resulting in high growth in US, and therefore harder to bring inflation lower back down. So, but finally the rate cut is coming. We expect that to happen in September. Okay. So inflation has dropped a lot, more so in the second half of 2023. So in a lot of the drop in inflation happened in the second half of 2023. So for the first half of 2024, you can see that the inflation is more sideways. Similarly, if you look at the month-on-month data, this easing of momentum for inflation was very apparent in 2023, and then come 2024, we have had some uptick. Okay, so fortunately, the numbers are looking better starting May. So in fact, right now we have 2 months of good inflation data, meaning that inflation is easing. The May number, we have some retracement down by 2 percentage point year on year to 2.6. So this is for the for the month of May, and the month on month momentum also eased a lot to just 0.1. The May number refers to the CPI number that just came out. So for CPI, it is 2 consecutive months of lower inflation for May and for June. Okay, we expect this inflation to continue to recede, although it is happening at a very slow and gradual pace. Okay. So the latest support, so to speak, for the rate cut to begin is there's finally some sign that the job market is cooling down. So for April, May, June, the unemployment rate has crept up a little bit. So inching up slowly from 3 point previously, I think March was 3.7. So it's crept up a little bit to 4.1. Okay. There's some statistic here to show, to illustrate that the job market in the US is actually very, very, very strong. So you have a participation rate moving up and going even higher than before COVID. So more and more people are rejoining the workforce because the economy is so strong, wages are high. So more people find it worthwhile to start looking for work to rejoin the workforce. So we have more people actually coming back to work. But despite the expansion in the labor force, we still have wages increasing at for the latest data 4.7% for the month of June. So the labor market is very, very, very strong. But lately we have had some easing in the job market, some cooling down in the job market. As you can see, job opening has been coming off. So we have had this situation, unusual situation during COVID, whereby the red line is higher than the blue line. Blue line is the people who are unemployed and looking for work. And but the job opening is a lot, and there's not enough people looking for work. So there's a shortage of labor in the market. And this gap is as high as about 4 to 5 million for quite some time. But finally is job openings are declining, and then unemployed people actually inch up a little bit. So this gap has been coming down from like 4 to 5 million to right now just about 2 million. So there's some cooling down in the job market, but it happened only just the last 3 months. There's some interesting research that I highlighted here by the very respected and famous Ben Bernanke. He co-authored this report with Oliver Blanchard, who is for many years the chief economist at World Bank. So together they studied inflation for 11 countries. So their conclusion is that lately, at the beginning, when inflation became a problem, it was due to supply chain. It was due to port congestion, etc., shortages, etc., high commodity prices, high oil prices. But lately, the inflation is caused by the tightness in the labor market, meaning shortage of workers. And they highlighted this ratio, vacancy over employment ratio. They feel that if this ratio dropped to about 1.2, then it is easier to get inflation under control and back to 2%. So I tried plotting the same ratio. Instead of vacancy, I use job openings. So based on this simple calculation that I have, this ratio is very marginally above 1.2. So it's a fine balance. So we are close to a situation whereby we can bring inflation back down to 2%. So finally, there is some support to say that there is greater confidence that inflation will get back to 2%. That means the Fed can cut interest rate starting September. Okay. But the amount of rate cut may not be a lot. So if you look at bond yield, on the left we have 2 and 10-year bond yield for the US market, and then also the same thing, 2 and 10-year bond yield for the Singapore market. You can see that they are still very elevated. There is fluctuation over the last 2 years, but they remain very elevated. The same thing is happening in Singapore. Our bond yield is not as high as that of the US, but again, over the last 2 years, bond yield has been quite high. There is changes in expectation, and there is ups and down volatility, but bond yield remain quite high. That indicates that over time, on a longer term basis, people do not expect interest rate to correct. They do expect interest rate to drop. They do expect rate cut, but they don't expect that the magnitude to be a lot. Okay. So we've done our revision. The revision is quite small. The earnings revision that we've done, we're quite small. As I mentioned earlier, there is changes in expectation for interest rate, but those changes are very, very, very small. So the good thing is that more people are now confident that there will be a soft landing, meaning that the economy continue to grow. Back 6 months ago or 1 year ago, there's a lot of fear that there will be recession. That is not the case now. Most of us expect the economy to continue to grow. The NIM compression is happening in 2025. Okay, so we are expecting a 9 basis point drop in NIM for 2025, 8 basis point in the case of for DBS. In the case of OCBC, we're expecting an 8 basis point drop. In fact, because loans growth is expected to expand by about 5% per year, so the NIM compression is small, and it doesn't cause a drop in net interest income because the base of loan continue to increase by about 5% every year. So what the NIM compression does is that it slows down the increase in net interest income to just about a 1% increase in 2025. So it doesn't, the compression is small. It is so small that it is not going to have a negative impact on net interest income. Net interest income will be quite flat, and increase only by maybe about 1%. So ROE will be lower. When interest rate was at its peak for DBS, the ROE is 17.7. In 2025, interest rate will be lower. Fed fund rate will be about 4% by the end of 2025. The ROE, because of the lower interest rate for DBS, the ROE will be lower at 15.9. And then for OCBC, instead of 13, the ROE for 2025 will be lower at 12.5. So you can see from the chart that the NIM some receding, but the net interest income will be quite stable. Okay, asset quality for the banks remains quite solid. As you can see, NPL ratio remains very, very low. For DBS and OCBC, the NPL ratio is close to 1%, which is very, very low. They continue to have buffer on their balance sheet. They have management overlay for general provision, meaning that they make more general provision than is required by their models. In the case of DBS, the extra management overlay for general provision is 2 billion. For OCBC and UOB is about 1 billion. So they make more provision than is required. So there are buffer on their balance sheet to absorb negative shock if the economy does slow down. Their capital remains very, very high, particularly for DBS. CET1 CAR ratio at 16, so they can well afford to make the general offer for Great Eastern. And even after doing that, their CET1 CAR ratio will still be the highest in the sector. They are known to be the safest globally, and they are ranked about 12 for DBS, 13 for OC, and 15 in the world for UOB. So they continue to have strong balance sheet and continue to be very safe banks. Okay. So finally, on valuation, as you can see, DBS is slightly above the long-term mean. For OCBC and UOB, valuation is more attractive. They are just slightly above one standard deviation below the long-term average. So both OCBC and UOB, they are trading below the long-term average. So for DBS, ROE they are quite confident that they can deliver ROE of 15 to 17% over the next 3 to 5 years, despite the fluctuation in interest rate. For OCBC is a new management team, and I would say that their execution and their earnings has been more, we see growth and we see more better execution from OCBC since the new management took over in 2 years ago. They have a lot of surplus capital, and what they try to do is to deploy the surplus capital for state acquisition to generate more inorganic growth. For UOB, they have completed the acquisition of Citigroup's consumer banking business in Malaysia, Indonesia, and Thailand. So starting second half of this year, the expenses for integration is expected to drop off quite significantly. So they will benefit more from the acquisition of Citibank's consumer business starting second half of this year. Okay. So just to revisit the issue about dividend, okay, our expectation. So right now, DBS is paying about 54 cents every quarter. We expect that by end of this year in 4Q, they'll increase dividend by 6 cents. So increasing it from 54 to 60. That's about 11% increase. And if you extrapolate that into next year, 2025, 60 cents per quarter means $2.40 per year of dividend. That's the payout ratio will be a little bit elevated at 65, but that is supported by this very high, this higher ROE of 15.7% that we have highlighted earlier. OCBC, they paid 53%. They're committed to pay 50%, but last year they already paid 53%. So we do expect that their interim dividend will increase by 2 cents in the second half of this year from 42 to 44. That's an increase of about 5%. Okay. For UOB, they're committed to paying 50% and $1.78 for 2024 and $1.85 for 2025. That's based on consensus estimate. Okay, so just to illustrate their ability to pay dividend, since 2016, the dividend has doubled or tripled. Same thing for OC, and then same thing for DBS. The bank has been paying more. Yield-wise, I think DBS a little bit higher, 5.9% this year, 6.3% next year. For OC, 5.6% this year, 5.8% next year. For UOB, is purely based on consensus estimate. We have it at 5.4% this year, and then 5.6% next year. So to conclude, I would say that the recent run-up in share price is, I believe, mainly triggered by expectation that interest rate will be higher for longer. Yes, there will be rate cut, but the magnitude of the rate cut will be quite small. And on the longer term basis, the banks, they have quality of earnings, and they can deliver yield that is stable and high at about 6% for the foreseeable future. So we continue to like banks, but maybe in terms of preference, we have changed. We do prefer OC, and then we are less positive on DBS. The run-up has been very steep for DBS, and therefore we saw that it is reasonable that it will maybe pull back somewhat. So we continue to like the sector, but our preferred stock is OC, maybe to a smaller extent UOB, and our less preferred stock is DBS. So with that, I like to pass the time over to Curtis to talk about Hong Kong. Over to you, Curtis.
Okay, thank you, John. Now we are going to talk about Hong Kong stocks. And for the second half outlook. And first of all, let us make a market update about the Hong Kong stock. In the first half of 2024, the Hang Seng Index has made an impressive gain since bottom out in late January, bringing year-to-date performance to around 6%. This is a remarkable turnaround, came after the government gave clear indications that it remains firmly behind the healthy developments of capital markets, and efforts to drive the property market will no longer be crowded by concerns of the bubble. And about the valuation of the Hong Kong stock, the Chinese equity has been cheap or undemanding for a while, as we know, and the Hang Seng Index is now trading at about 8.4 times 12-month forward PE, and a load of 7.1 before the rebound. This is because investors, rightly or wrongly, were concerned about the Chinese government's commitment to support the economic growth versus pushing for further deleveraging. Moreover, policy at times were not well coordinated, and investors felt the government's hesitation over policy easing for fear of the property bubble, thus adding to the confusion. And the government eventually recognized that policy coordination had to be improved. This was highlighted during the two sessions in March, and things have since changed for the better. It is no surprise that we are seeing renewed investor interest of of the Hong Kong stock, especially following the government's announcement of plans to enlarge the stock connect scheme. And this came after an earlier policy announcement aimed at prompting a healthier development of the Chinese stock market. And moreover, there was further easing of property purchase restrictions and plans to help with property destocking, rising hopes that the residential real estate slump could end sooner. And all these have contributed to the better sentiment. And globally, we see that there was increasing fund flow to emerging markets as global investors seek out higher returns now that cash ratio of US mutual funds have hit a low. And data from ICI shows that the cash ratio of US mutual funds fell to 1.9% by end of 2023 and reached 1.8% in March 2024. And this rotation support the breakout of the emerging markets from its multi-year resistance level, and Chinese equities thought one of the most attractive valuation in the States. So we believe there will be a normalizations for the valuations of the Hong Kong stocks. And overall, our strategy is to stay positive but expect greater volatilities for the second half. While the rally in April and May, investor opinions on Chinese equities are now split. Some remain quite confident on the rebound, while others believe that a significant bottom is now in place. We believe that the low are in, but the bigger question is how much further upside should we expect? And we started this year with a target of 20,500 points for the Hang Seng Index, based on a target of 12-month forward PE of 10.1 times. And now we still hold the view that valuations should re-rate at 10.1 times from the current 8.3 times. If there is further policy clarity and continuity backed by evidence of incremental economic improvement, hence the coming third plenum in this month will provide investors the first opportunities for a reality check. And for now, the 12-month forward EPS is at around 2028. And we expect this level to be reached in our target to 20,500 to be reached in the third quarter and after the important meeting this month. And in terms of technical analysis, the Hang Seng Index bottomed at a low and earlier this year, and the rebound between April and May turned the trend from bearish to bullish. And we see recent pullbacks as a healthy consolidation after a big rally. The index supporting area will be from 17,300 points to 17,500 points, constructed by the 250-day moving average, 100-day moving average, and the 0.618 Fibonacci retracement level. Given that the index stays above the supporting level just mentioned, we are still optimistic about the trend. And overall, we expect Chinese equity to stay supported as we see demand for investors who have missed the initial rebound and would now look to increase exposure ahead of the meetings. While there are expectations that the meeting will deliver additional positive catalysts for the economy, on this front, we expect further details on resolving the residential housing inventory, a debt workout plan for local governments, and measures to boost employment, key areas that can help reduce the systematic risk and see further PE re-rating the valuation. We will further elaborate, and we also expect market volatility should rise as we head towards the US presidential elections in November as China brushing its politically convenienced. And let's go through some issues to monitor in the second half. First of all, is the supportive policy for property sector. As economic confidence remains low, money supply and credit growth stalled in recent months, both April and May, in falling transitional demand for money and credit. Over this period, net new loan to household were negative as well. At the same time, the new inflation data was also mainly driven by falling housing costs and price competition in the auto sector. Thus, a sustainable economic rebound is very dependent on the real estate sector. And on mid-May, the Chinese government announced a series of measures and RMB 300 billion in funding to help ease the inventory in the property sector, as well as funding for whitelisted developers. We think that it is a good start, and as we can see that the building blocks for sustainable bottom is being put in place. And the key measures on the demand side are first, the minimum down payment ratio for first and second homes purchase were reduced from 20% and 30% to now 15% and 25% respectively. And second, the floor of first and second home mortgage interest rates will be removed. And the PBOC will provide RMB 300 billion in low cost as PSL to banks. And this will be used to support local SOEs in acquiring completed unsold units from developers and converting them into rental or for sale government housing. And on the supply side, the government will further accelerate the implementations of whitelist loans. And also, they will urge developers to speed up developments of undeveloped land and support local governments in buying back raw land in the hands of developers that are experiencing financial difficulties and build more government housing. And this is an important step as the government attempts to resolve issues in both demand and supply. However, as with most policy, the devil is in the details and in the implementations. We think that the current scheme still leaves much of the decisions to the various parties, and pricings of assets is to be negotiated between the parties. And the potential bottlenecks are banks' possibilities. The eliminations of the mortgage rate floor is a positive surprise, but with the loan prime rate unchanged, banks are constrained in reducing mortgage rates due to the cost factors. And second, will SOEs be willing to increase leverage? The PBOC has planned to provide RMB 300 billion in cheap loans to enable financial institutions to lend to SOEs so they can buy completed but unsold apartments and resell or lease them as affordable housing. But investors would have to monitor the pace of loan disbursements. And third, what is the profitabilities for affordable housing projects? With the current low rentals, SOEs needs significant low funding costs to stay profitable in reselling or leasing these affordable housing units. But will developers be willing to accept low selling price while disposing of unsold units to SOEs? And considering the rental yield of only 1.5 to 2% in Tier 1 to Tier 2 cities, and government housing rental being kept at 90% of the market rate, the purchase price of these unsold units should be only 70 to 90% of the market price, assuming the SOEs have 2% funding costs. And thus, investors may want to wait and see before jumping to conclusions that a sustainable bottom has been reached in the property sector. And there are two key reasons for a rather conscious reaction. First is about housing demand gap remains wide. And in the first quarter this year, new home sales from the 100 biggest real estate companies slides 47.5% year to year, while a transaction area of second-hand houses in 70 cities was down 22%. And also, we should monitor that funding for whitelist program and the progress of it. And from the supply side, we believe continued extension of loan assets under whitelist is essential to ease the liquidity squeeze for the distressed developers and help resolve the risk of undelivered homes. We estimate that the size of unfinished buildings is 250 million to 500 million square meters, equivalent to 5 to 10% of the national GFA under construction, based on construction of a construction cost of 4,000 $4,000 for 1 square meters, and 1/3 of the construction completed on average. The funding gap to complete the project is around 800 billion to 1.3 trillion. And our base case is RMB 800 billion, and the pessimistic case scenario is RMB 1 trillion. And but it is also some very big uncertainties about the liquidities on it. And the second things we should pay special attention is about the effort to resolve the local government debts. Although the special purpose bond quoted for 2024 has been raised by RMB 100 billion to RMB 3.9 trillion, running in parallel efforts to scrap projects in highly indebted regions. The latter aims to put a cap on the pace of increase in new debt and improve on policy efficiency. At the same time, the policy bars 10 debt lending provinces and regions and 2 major cities from launching new projects and mandates stronger oversight and approvals. However, there remains some room for investment, including the 3 major projects of urban village redevelopments, affordable housing construction, and building of public infrastructure for everyday use and emergency situations. Key projects under the 14th five-year plan and projects that have surpassed the 50% completion can also receive new investment. While this is a step in the right direction, it's still uncertain by the scale of the problem that the government is trying to fix. By most estimate, local government debt, including off-balance sheet financial vehicles and shadow credit, is at around 75 to 90% of GDP. As a result, by 2022, 40% of local government revenue and transfer had to be spent on debt repayment. And so far, for the central government has asked the banks to roll over the local government's or LGFV debts at a lower interest rate to ease the burden. The cost of the debt will be split 3 rates amount. First, the banks, as they refinance existing government or LGFV debts, Second, the central government as part of the debt will be financed by special purpose bonds. And third, household as overall interest rate must be kept low. And the central government has also taken on a greater share of the fiscal financing with the decisions to start issuing long-dated special bonds to clean up excess inventory in the residential real estate segment. This multi-year effort will be indirectly supported by the PBOC, the debt monetizations that we alluded to in our previous report. And we see this as a positive step, and hopefully it will be brought out when necessary. And it allows the local governments more rooms for in the near term until economic growth returns to a stronger position before tackling the issues of over-indebtedness. And for negative or factors or risks, we think geopolitical and trade friction is the most important factor we should monitor. Geopolitical risk is on the rise. Apart from the domestic challenges, we expect Sino-US tensions to increase as we head towards the US presidential election in November this year. After all, China pushing is politically convincing, and Biden has just announced tariffs on around US 18 billion of Chinese export. The only positive is that it is still far below Trump's threat of 60% tariff, and recently the EU joined due to concern over competing Chinese EV imports. While Joe Biden was as the 76th president of the United States in 2021, China did not see any relief on the trade front that many investors had hoped for. In fact, most tariffs imposed under the Trump presidential were kept. And based on the latest data from the US International Trade Commission, the average weighted tariff on imports from China amounted to an effective rate of 12.5%, from only 2.7% pre-trade war, and compared with the general weighted tariff of only 1.47% for all imports into the US. And Donald Trump has threatened to raise tariff on Chinese goods to 60% and by 10% for imports from all other nations. And if it becomes true, it will not only have significant consequence for China, but also for US consumer and manufacturers. This will lead to onshoring of manufacturing for the US to a limited extent and probably only over the medium term. But the US trade deficit will remain as it is simply a function of the US being a net importer of capital. Moreover, onshoring requires the US to have relevant and skilled labor force. And in the near term, the much higher tariffs for Chinese goods will in most part only lead to trade diversions instead of a narrowing of the US trade deficit, which has what we saw during the 2017 to 2018 trade war. And moreover, over 40% of Chinese exports were conducted by foreign companies. Hence, a sizable number of companies of US and allied origins were also hurt by the tariffs. And nevertheless, this is a politically convincing move for the US, and China brushing will likely intensify. And second presidential of the Trump administration was what we deemed forced technology transfer. along with Chinese state capitalism to get hold of U.S. technology unfairly, particularly in dual-use technology. This led to the start of sanctions against violating Chinese companies and SOEs identified by the U.S. And looking ahead, we should expect more frequent declarations of threats to national securities rather than write the Section 301 of the U.S. Trade Act of 1974, as the former allows the U.S. president wider latitude in regulating commerce under emergency authorities, and the state is also being set for another area of confrontations with U.S. Treasury Secretary, the EU and IMF recently highlighting the problem of China flooding global markets with cheap goods due to her overcapacity problems. And industrials mentioned were in the new green industry, for example, solar panels and batteries and EVs. If Trump is re-elected, investors should prepare for re-escalation of the trade war. The data so far confirms that China has failed to honor most of the commitments made under the Phase 1 trade deal in the first presidential of Trump. Hence, Trump would be keen to raise the stakes to try to negotiate for a better deal, or even just to prove that he can win the trade war. And what should be the impact on Chinese growth if the U.S. does indeed raise the tariffs on Chinese goods to 60%? An earlier study by the IMF estimated if all the channels were in pay, enacted and proposed tariffs as well as retaliations would face peak GDP loss of 1.6% in China. And in the long term, once all adjustments have occurred, output in China would be just over 0.5% below the baselines. However, that estimation is based on lifting the average tariffs on Chinese goods from 2.7% to 12.5%. A linear extrapolation of that would suggest that the eventual impact of a hike in tariffs to 60% would be around 2.4% of GDP. And the fourth issue to monitor in the second half is the further monetary easing in China. 50 basis point cut in RRR was implemented on February. That will release RMB 1 trillion of liquidity. And PBOC has indicated during the two sessions that there will be room for further cuts during the year. We expect at least another 50 basis point cut, and increasing bond quota for special purpose bond by RMB 100 billion to RMB 3.9 trillion. And the government has committed to issue special bonds for the coming few years. And for 2024, the quota for the later is RMB 1 trillion, and it has been reported that on 30 October last year, President Xi has told China's financial authorities that the People's Bank of China must be gradually increase the trading of treasury bonds in its open market operation as a means of injecting liquidity into the economy. And in the face of rising geopolitical risks, we believe that the Chinese government will step up on policy reflection. Hence, the expectations that there will be further funds to support the stocking in the property sector and thus there will be increasing resilience on the central government to adopt more expansionary fiscal policy too, funded by special purpose bond issuance. This issuance will be supported by the PBOC, similar to the arrangement announced in just mentioned second half 2023. And there should also be additional cuts to release additional liquidity. Thus, we are forecasting an improvement in M2 growth by year end, despite the recent slowdown. And overall, for the Chinese economy, we expected China has some challenge, and in our base case scenario, the Chinese economy will stay on gradual recovery path with real GDP growth of around 4.5% this year, and growth will, however, be increasingly driven by domestic factors in place of net exports. And global demand is showing signs of an immediate slowdown again, as the global PMI for manufacturing looks to have peaked. And also, again, this backdrop for the stock selections, we prefer exposure to domestic consumption, beneficiary of policy support, new productivities growth, and structural growth in AI. Hence, since the Hang Seng Index bottom in June, in the first month this year, the index 12-month forward PE has re-rated from 7.1 times to 8.4 times, while the 12-month forward EPS has been trended. On a sector bias, energy, materials, real estate, and communication services has underperformed. However, two of these sectors are largely influenced by global factors. The real estate on expectation of further policy support, and communication service rebound of online gaming names and attractive high use of telecom operators. And looking ahead, as long as the government continues with its efforts on the property sector destocking, we expect investor sentiment to stay positive. In this case, the Hang Seng Index valuation should re-rate to 10.1 times 12-month forward PE, level consistent with the previous round of valuation normalization, and further index upside will have to be driven by earnings improvement. And investment theme for the second half, we think we should focus on first consumption recovery, and consumers are still looking for value for money in China. So smaller ticket items should still see better sales growth. However, the bordering of the recovery should lead to better overseas travel growth, which should finally lift duty-free sales. Finally, hopefully. Advertising revenue growth should stay resilient as well, benefiting technology, media, and telecom names. We also expect selected F&B names to enjoy better growth in the second half, helped by the Olympic Games event. And second themes about improving net interest margin outlook. The need to provide additional funding for the property sector should lead to additional cuts in the second half, and this would be positive for the banking sector. There will also be easing concerns on asset quality. Loans demand is the only drag on the macroeconomic outlook, but if our view that the economy is on a recovery path is correct, the former should improve by the second half. And the third investment theme is the new productivities growth sector. This is a structural growth theme for China and many sectors, be it AI, semiconductors, automation, new materials, EV, and renewables. We focus on names which are profitable or expected to turn profitable in the near term. And the last investment theme is property sector. With the policy support for destocking, we expect the share price of developers to be on an uptrend, though trading could be volatile as investors wait for confirmation that the recent policy will gain traction. We expect leading POEs and the property agency brokers to outperform. In line with the above themes, we are overweight on consumer, discretionary, IT, and financials. For some topics here, we suggest to keep eyes on Tencent, Lenovo, Trip.com, Geely, and the CM banks. So that's all for the Hong Kong stock market strategies. Now we go to the Q&A section.
Okay, thank you, Curtis, for the comprehensive presentation. We now commence the Q&A session. So I will start with a few questions on the banks, and I will maybe not the first question, but the second and third question, I may need the help of some of the slides. Okay, first question relates to banks from Patrick. Thank you for the question. His question is, with likely Trump presidency, is it likely for inflation to increase next year? Do you think the Fed rate, fund rate will fall next year? It is a very good question. Unfortunately, the answer, there are a couple of points I like to share with you, but it is very, very uncertain whether Trump's various policy, whether he say it, whether he can implement it, that is altogether another question. So certain things that Trump intend to do will cause higher bond yield and higher inflation. Other things that he would want to do may cause lower inflation and therefore lower bond yield. So it depends on the various things that he want to do, whether which one is implemented first and which one didn't get implemented. So for things that he will do that will cause higher bond yield would be number one. There is talks that he may cut tax again. So he has, of course, when during his first term, he has enacted a tax overhaul in the year 2017. That was a very broad and comprehensive package of tax cut amounting to US 1.5 trillion. It is due to expire in 2025, and Trump, if he get elected, will extend those tax cut. But there are also people saying that there will be new rounds of tax cut, both for the individual and also for corporate, for companies. He hasn't shared those details as yet, and his advisors and aides are working on drafting some of those new measures. Unfortunately, we do not have the detail. Okay, so secondly, and which was also mentioned by Curtis, Trump intends to institute sort of a universal 10% tariff on all goods imported in the US. So this is pretty controversial because any import from any country will be subjected to a 10% tariff. So it will be controversial. Some countries may retaliate, EU may retaliate, China may retaliate, maybe even countries like Japan may have no choice but to retaliate. So it is very, very uncertain if he could pull this off. And obviously, he's well aware that the budget deficit is getting out of hand at 7% of GDP for the current financial year. It is way too high. So if he continue to cut taxes, that 7% will go to even higher levels, which is unthinkable. If he institute, a universal tariff, the consumer is going to be affected, and consumer inflation will increase. So all these things that he tried to do is controversial. Whether he managed to implement them is debatable, is questionable, and we do not know which one gets implemented and which one doesn't. Things that may lead to lower interest rate will be he tend to being a ex real estate developer while he still own the Trump organization, and his kids are running the real estate company. And as the developer, he has very close relationship with the banks, and he likes low interest rate because developers benefit a lot when interest rate is low. And if you remember, during his first term, in the year 2019, particularly I think the first half of 2019, he threatened to remove Jerome Powell, and eventually in the second half of 2019, there was three interest rate cut, each one of 25 basis point. Jerome Powell at that point in time refers to them as insurance cut, very peculiar. So in his first term, he has managed to pressure the Fed and managed to get interest rate lower. So if he gets re-elected again, will he do that again? Chances are is that he may try to do that again. In fact, his advisors are talking about a restructuring of the Fed. They want to change the way that things are done. They want to change the organization, and details are not out, but generally he prefers low interest rate. So there's a mixed bags of potential action point. Some lead to higher inflation, some lead to lower inflation, some lead to higher bond yield, some lead to lower interest rate and lower bond yield. So it is a bit uncertain which gets implemented, which doesn't. And one good example during the first term would be that he wants to build a border wall, and he is always talking about that. But at the end of the 4 years, he didn't manage to get the wall fully built across the border. And some of the nitty-gritty detail is that he didn't manage to get the funding he needed to build the wall. And that kind of prevented him from doing what he wanted to do. So it is a very good question, it's a valid question, but it is a bit difficult to pinpoint exactly which of his agenda get done and which doesn't. So generally, I think there are more things that lead to higher bond yield than things that lead to lower bond yield. So I guess as a general inclination, he's going to be very proactive in fiscal policy. And then because of all the things that he planned to do, I think overall net, a higher chance that inflation may be slightly higher and then bond yield may be slightly higher. And as to the reaction in the bond market, I think it is up and down. So after the debate, there was like 2 or 3 days that bond yield went up, and then subsequently bond yield went down. So I think it is a bit inconclusive. So something that we need to monitor and continue to pay attention to. Okay, I'll move on to the second question on banks. Is from Kenneth. What should I do if I'm still underrepresented in SG banks? So difficult question to answer. So share price has ran up quite quite steeply, and obviously we won't suggest that you chase. But if you want to nibble into one or two of the banks, then I think we see OCBC as um, having not run up as much, and then also I think valuation wise in terms of price to book is cheaper. For DBS, maybe we have to wait for more retracement. So maybe you can consider nibble or buy a bit of OCBC, and then but to take up big position, I think we maybe have to wait for things to cool down a little bit before we get back into the sector again. The yield definitely is very attractive at about 6%, and we are talking about quality earnings, and the bond yield suggests that interest rate may drop a little bit, but will still be quite high. So I think I will, it is you may want to consider buying a bit of OCBC, and then over the next 2 to 3 months, if there is retracement, there is correction, then you can consider buying more banks. Okay, so I move on to the third question. How is Singapore banks compared with peers in the region? So I need the help of the slide. Okay, thank you. I hope you can see the slide. So I just like to highlight that if you compare across the board, I think you will notice, I think most of the country have some stock with pretty high yield and then some stock with lower yield. But for Singapore banks, I think all three are quite high yield, north of 5%. And in the case of DBS and OCBC, for 2024 is high 5%. In the case of 2025, DBS hit 6.3%, OCBC 5.8%. And one differentiating factor is that I think maybe one or two of the Malaysian banks, they have scrip dividend that help to support the high dividend yield. But in the context of Singapore banks, it is pure cash. The dividend is paid to you in cash. If you want to use the dividend to buy more shares, it is entirely up to you. So yield is quite high and quite homogeneous. Second point is that for Singapore banks, ROE is quite high. So I think in the past we would Singapore banks, I think the ROE would be lower than peers. But that's not the case now. We have DBS ROE at 16.8 this year and then 15.5% next year. For OCBC is 12 to 13%. So that is comparable. Even for the DBS, is comparable to the highest ROE that you can find in Malaysia. It is higher than most of the banks in Thailand. So I think regionally only Indonesia have high ROE. So Indonesia, I think there are banks with very high NIM, net interest margin, and then therefore very high ROE. But of course, that for Indonesian banks, ROE has been high for quite some time. And then the third point that I like to highlight is that if you're weighted in Singapore banks, you get to benefit also from the strong Sing dollar. And I think Sing dollar has been strong over the last, during COVID and after COVID as well. Lately, some retracement, some rebound in regional currency, but to a smaller extent. So other banks that we may consider regionally, in Malaysia, our analyst based in KL, his top pick is CIMB. He has a buy call target price of 760 ringgit, and yield is 5.8% this year and 6.1% next year. I think his basis for recommending CIMB is I think their corporate business is doing well, and also the foreign ownership is quite high. And so as and when the foreign funds come back, the share price would have a higher beta. You know, if foreign funds flow back to Malaysia, I think that is the case right now. CMB has a higher beta when the market do well, and then when the foreign funds come back to the KL Stock Exchange. Okay. For Thailand, our preferred pick will be BBL because it is most conservative provision. Having the most adequate provision, and then maybe beta wise it is not so high, but it is a big corporate bank that give about 5% next year and is very conservative and very safe. So for Indonesia, my preferred pick will be Bank Mandiri. Yield is quite high at 5% this year and then about 6% next year. And then they have they are a big corporate bank. So the corporate bank is doing well, is their bread and butter. The growth is coming mainly from the consumer bank, be it for payroll loans and then maybe even auto financing. So they want to catch up and grow even bigger. For corporate bank, they are the biggest already. So for consumer bank, their market share is not as big, and then they are working very hard to grow their consumer business. One thing that I like about them is that they are deposit franchise. So even in an environment where interest rate is high, when the smaller banks are struggling, even some of the big banks, when interest rate is high, even some of the big banks may struggle to collect enough deposit, but they don't have a problem with that. They have innovative deposit campaign. They give like preferential rate to their top customer, the high net worth customer, and they always manage to collect sufficient deposit to fund their growth and their expansion. So the funding franchise is quite strong and quite remarkable. So for Indonesia, if you want very high ROE of 20% for Bank Mandiri, I think for me, having met them would be my preferred pick. Okay, I move on to the fourth question before passing the time to Curtis. So my last question would be, I'm having a bit of difficulty with the question. I think he say question from BG, and he asking about the preference of OCBC over DBS. I think DBS, I think we mentioned about Basel IV, and I think he's asking about how Basel IV would affect our preference and then also dividend from the three banks. So what we have forecasted already, I kind of like recognize the fact that Basel IV will be implemented. So the implementation of Basel IV, some people call it final reform for Basel III. So there are different names to this same thing. So let's call it Basel IV. So Basel III was announced maybe somewhere around 2012. Full implementation, I remember, was 2019. So when we started to implement Basel III, and then when it is, we get familiar with it, and then we realize that, it doesn't affect us that much. And that was when we started to have an increase in dividend for all the three banks. Basel IV was announced and then finalized only recently. The implementation will start in July this year. I think the impact to us, Singapore banks, is neutral. Some banks in Europe get affected when the way they calculate capital is quite aggressive. Those are the banks that will be affected. In the US, they decided not to follow. And recently, I think if you read the news, they have a watered down version that will be implemented in the US. So for Europe, Singapore, yes, we will be following, we will be implementing for Singapore starting July. Impact is neutral. So that dividend continue to increase. For OCBC and UOB, they have a policy to pay out 50%. For DBS, lately they are trying to toggle their quarterly dividend to a higher level, and how they derive the amount to pay is based on their ROE. So they try to calculate, and I've done that calculation before, and management has announced that they are quite confident to maintain ROE at 15 to 17%. So if you take the lower number of that range, which is 15%, and then use the standard finance formula, you get a payout ratio of around 65. So a ROE of 15%, which is the lower end of their range, can support a regular payout ratio of about 65%, which is what we have. So if you look at what we calculated, so end of this year, 4Q, they increased dividend from 54 cents to 60 cents. Next year, they pay $2.40. That's exactly the payout ratio of 65. So based on ROE 15%, payout ratio is can support our payout ratio of 65%. So the other two banks maybe a bit more conservative, but their payout ratio is 50%. So if it is a more conservative way of this. So this is for OCBC they are more conservative, and we still get that run up or that increase in dividend. But should there be right now it's not within our forecast horizon, we're not seeing a recession. But if it does happen 2 years down the road, 3 years down the road, there is less risk that OCBC and UOB have to like cut dividend by a lot because their payout ratio is less. In the case of DBS, payout ratio is higher. So in the event that there is a recession, then maybe there is some risk that those dividends may be reduced. So DBS give higher yield with a higher payout ratio, and then OCBC and UOB is more conservative. Payout ratio is lower, but yield is still quite reasonably high at about 6%. Okay, so maybe I pass the time over to Curtis for a few questions on the Hong Kong market.
Okay, thank you, John. I saw the first questions about the potential impact of the supporting policies. And as we mentioned in the presentation, we think that further and significant policy support, for example, by the third parliaments and the Politburo this month, will help the normalizations of Hong Kong stock on the valuations from now only 8.4 times forward PE to the average levels of 10.1 time PE, which imply a target of in the best scenarios 20,500 points for the Hang Seng Index, and for the different markets onshore or offshore, it's very hard to say which market will have more upside. But we have to, in both top-down and bottom-up method, to spot the real beneficiary of the policies. As we mentioned, we think that the technology, hardware, the some banks and developers will be the potential beneficiaries of the policy. And we can find some of them in the Hong Kong markets. And the next question is about the media real estate story. We do not cover this stock. And the next one is about the Hong Kong office and retail space. We remain conscious about particularly the retail space and the related names. The market underestimate the trend of shoppers heading north. The number of Hong Kongers entering mainland China in March hit 8.2 million, up 76% year on year. And we estimate the impact of northbound consumption on Hong Kong's retail industry at 5 to 10%. And the recovery of overall retail sales was inevitably below our expectations, with down 7.9% and down more than 14% year on year recorded in March and April, respectively. However, the persistently high interest rate and weak office market are in line with our expectations. And recently, we lowered our forecast of Hong Kong retail sales growth year on year to 2% from 5% year on year previously. So we really remain conscious about the office and the retail sales space. And the next question is about the insurer, AIA. About AIA, it still remains our topics in the sectors due to the leading premier agency force with the most million-dollar round-table members and the huge upside potential from geographic expansion in China and focus on resilient middle class and above customer segments where demand remains robust despite economic headwinds, and also high-quality product propositions focusing on traditional protection and differentiated long-term saving products, and also better shareholder returns and enhanced capital management policy. We keep the buy rating and the target price is $85 and implies 1.9 times 2024 forward PEV. And although the street expect AIA value of new business growth in 2024 to slow down to about mid to high teens level due to the pent-up demand from MCV after the Hong Kong-China border reopened, we still believe the insurer's current valuations does not fully explain its insurance fundamentals, given its improved shareholder returns of 8% after the additional share buyback and promising growth outlook in China and sustainable MCV business in Hong Kong. And the next question is about autonomous driving. We think that there is surely some impact on existing ride-hailing companies from the rising competitions by big tech companies developing the autopilots. For example, in fact, the recent issue is raised by the developments of the Baidu autonomous driving in Wuhan and Guangzhou. And Baidu is in exactly newcomers to the markets, and it may give pressures on the existing ride-hailing companies on their research and developments on the autonomous drivings, and it may enforce larger capex, and also the rising market competitions will pressures their margins and force them to potentially launch more promotions. But indeed, it is a very early stage for autonomous driving in China now, and the developments in some cities like Wuhan is just a pilot scheme, and also we think that it may have some impact on the ride-hailing companies' drivers, and it may create more uncertainties for the developments of autonomous driving. So at this stage, at this moment, we don't think the developments create big troubles to the existing companies. And one more question about the link rates. We do think that the valuations of link rate is very attractive, but as we mentioned, we remain very conscious on the Hong Kong retail sales, and we lower our forecast of retail sales growth for the whole year 2024. In near term, it may not be some positive catalyst for the link rate, other than the potential rate cuts in US may bring some support to its valuations. And in fact, although we keep our buy rating on the link rates, our target price is only around $44, implying not much upside potential.
Okay,
and,
thank you.
Oh, thank you. Sorry, I saw one more question about the Hong Kong CAC ETF. Well, we think that given the recent conscious sentiments, the near-term upside of the tech industry is capped, and we think that among the tech industry, not all big techs will be the beneficiary of the potential supportive policy, as we are only relatively optimistic about the gaming sector, but not the e-commerce. We think that the tech ETF may not be a very good pay in the Hong Kong market. You may search for some individual stock-backed tech names rather than owning the whole tech index. And anything you would like to add, John?
Yeah, thank you, Curtis. So I have sorry. There's two questions on banks, and excuse me. Firstly, the estimated target price for DBS, that is 41.40. Based on last Friday's closing price, share price is 37.93. So recently, of course, the share price pushed above $88, but it seems like as they move nearer and nearer towards the target price of 41 and towards this technical barrier of 40, it seems a little bit hard to push through that, and therefore recently we have a pullback. So yes, I mean the upside is more limited now because share price has moved quite close and quite near to the target price of 41.40. Okay. Second question is about, are there a small number of small, medium, and regional banks that collapse or merge into one another? Will such a disappearing bank issue affect finance stock? What will be a positive catalyst. So I think you are referring to the US. In the US, there's a couple of regional banks that collapsed. Some of them got bought over by other bigger banks. So there's no one single issue. There is some banks are affected by exposure to commercial real estate. Secondly, some banks they invested in government bond when interest rate is zero. So subsequently, when interest rate went up, they suffered losses for those investment in actually government treasury bonds. So there is some mismatch in their balance sheet, and then their exposure to bond was a little bit way too high. Thirdly, there is one or two banks that actually they function as part of their business is to provide payment services for some of those crypto platform. One of them is the major customer is FTX. So this I would say I would narrow down to various factors, and these I think are the three largest factor. Do they affect systemic risk in the broader US banking market? The answer from the Treasury Secretary is no. The answer from Jerome Powell is also no. They are saying that the problem is contained, and then they are saying that it doesn't have a knock-on effect on the broader economy or the rest of the banking sector. And so far, recently, we have not got more banks having difficulty. So it's been quite some time that banks run into trouble. So seems like the problem is contained, and hopefully the problem is over. Was there positive impact on some other stocks? Yes, I think JP Morgan they bought over one of the regional bank, and in some of their recent results, they actually reported good numbers because they rescued the bank, and then that bank contributed to their bottom line. So was there some positive end result? Yes. In the case of JP Morgan, yes, they benefited by buying over one of those troubled banks. Okay, so time now is 8:07. We are very thankful that you invested time with us. So thank you for attending our presentation today. And in the interest of time, we have to call it the day. We are appreciative of your participation, and we like to thank you once again for attending our webinar. So thank you, and good night. Over to you, Venice.
Yes, thank you, Jonathan and Curtis, for your insightful presentations. So for more of our upcoming webinars, please visit youtrade.com.sg. So once again, thank you for joining us today, and enjoy the rest of your evening. Thank you.
Thank you.